Okay, in this video we're going to take a look at the history of spread quotes in CQG. We have four charts here on the screen. All four of those charts are the same spread. It's the ICE WTI crude contract versus the Brent crude contract. In the upper left-hand corner we have a 5-minute chart. This is the original way that we have spread in CQG. This is either called an implied or synthetic spread. It's simply taking the difference between the two legs. So it's ETZ minus QOZ. And our last on that is discount $19.11. Our second way to display this is through what we call a spread, bar spreads. And to get there, you right click on the title bar of the chart, pick spread bar, and put your spread in, and then you want to right click on the open, high, low, close bars, modify it. And what this tells us is that this 5-minute consolidated or spread bar chart is compiled from 1-minute implied or synthetic data. So 1-minute snapshots, or the close at the 1 minute, is compiled to make the open, high, low, close bars on this spread bar chart, this 5-minute spread bar chart. You can change the interval, but make sure the interval is always lower than the time frame you are looking at on the chart. Alright, our third chart is simply what we call an exchange traded spread. Again, this is the WTI ICE versus the Brent. And this particular chart is quoted from actual trades of that spread. In other words, when you buy or sell this spread, you're buying it at the spread price. So if I bought this spread right now at the current last price, I would be buying the spread at discount $19.05, and tomorrow's statement would show individual legs for each one of the components that make up the spread. And the reason you get separate legs on your statement is if you need to leg out of the spread, you can do it that way. And then the fourth way that we can look at the spread is through what we call our spread function. The spread function allows us to build open, high, low, close bars again, and these bars are built on millisecond timestamps. To create one of these spread charts, we want to open up the formula toolbox, go to Q Formulas, and then I have one here that's Q7 WTI Brent underscore ICE. And when you type in spread, I put in the two legs. And then if I go to setup, you can see currently by default it is a bid-ask calculation on each of the legs. In other words, it's going to be the spread on one of the legs bids versus the ask on one of the legs spread. Now we can change that to trade by trade, which I normally do, and apply that to the chart. This particular chart is a trade by trade spread of the WTI ICE versus Brent. Out of all four of the spreads, the one that has the most granular activity for backtesting or analytics is going to be the spread function chart, the last one we looked at. This is Doug Janson in Denver. If you need to get in touch with any of the product specialists, 1-800-525-1085.